Hi guys, today we will discuss hedging risk reversal on charts. Now, the reason to do hedging is you have owned a stock, it has risen, and now you are in good profit. And you want to save that profit. You believe the market will go straight or down. And if it goes down, you don't want to risk far more money. Now, what do I mean by going down? Usually, if you look at any stock, it can open lower. Example right here. If you look at it, this is open, high, low, close. This is the top Bollinger Band number. This is the bottom Bollinger Band number. And this is the middle, this red line number. Now, right here, it closed at 52.48. But the next day, this O is open. But the next day, it opened at 52.38. So that's a difference of 10 cents. Now this might not be a real difference, but there are like real difference. Example, right here. It closed at 51.48. It closed green. You were very happy. But what happened next? It opened at 49.58. Now this is 51.48. This is 49.58. That means approximately $2 down. That's 5% down. Now these are the risks that you don't want to take. And to save yourself from these risks, you usually apply hedging. Number one. Number two, result. Example right here. The result came, it crashed. So you can apply the hedging thing so that you don't get caught in it. You can apply it with a really low band. Example, you can put a highest high at further away, because if it goes high, you can claim it and sell your stock at a high point. And you can claim the previous low. Example right here on this day, we can claim the previous low right here, this red candle low. And this will act as a put option. So if it goes down due to the result, we simply sell. It automatically gets sold because someone will claim your stock and you have to sell it. So this is the number one thing. Hedging. On the result day, you don't want to risk it. Even if the result is good and the stock goes down, you don't want to risk what you have earned. So you can put the call option at a really high price, so that if it touches that, you get more profit. And you can put the put option really close. But that is when you have earned good money and you want to save each and every penny. You don't want to risk anything. This is the first part. The second part, the hedge fund mentality or the high net worth client mentality. They usually don't want to save each and every penny. What they want is, they should know what really the trend is. If the trend goes against them, they want to get out and throw that stock into a negative list. Reason being, they want to be with the trend. Either they make money or lose money. They want to be with the trend, not against it. So let's see how it goes. Now let's assume we have bought the stock right here at 51.91. Okay, it went down, we stayed, it started to go up. We are in profit, right? It is still going up, profit. Awesome. We bought it at 50.51. It's now 56. Brilliant, right? But right here, the Bollinger Band have contracted on the result day. So before the result day also, we could have applied our hedging strategy with the risk that the result could be really bad and we could have we need to sell it off. Now this green line will always act as your high point. So if the result is good and it goes up, it touches your green point. And you get to keep a far higher profit, because right here the stock is trading at 57.44. Right here, the C close. And if it goes up and touches your point, Let's presume we put it at 60. Boom, that's awesome. 5-6% profit more. And the hedge fund mentality is to put it like near the trend changing number. Now my trend changing tool is Bollinger Band. If it contracts and the price goes below the Bollinger Band, then it's a downward trend. So your upward trend where you bought at 50, 51 and it went to 57 would change at 56. So you are putting in a $1 risk on the presumption that if it goes down, it's already bad. So why take risk? If it goes up, then this is a good number to save your profit and go home and have a good sleep. Because if you bought it at 50, 51 and it's going at 60, that means $10 profit, 20% profit. That's huge, right? So these are the two things. Number one, as we discussed earlier, you can apply the put and call options, that is the put option really close. So if it goes down, you get out claiming the full profit, only few cents lost. Number two, the hedge fund mentality. That is, you will have the put and call option really further away. So if it goes through the put option, that is this red line, then it means the trend has changed and you don't want to sit within the bad trend. If it stays in between, you get to keep the premium profit and the stock as well. So let's see what happens next. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Let's presume we have put it on a 30-day expiry date. 11, 12, 13, 14, 15. Now on this 15th day, we bought it right here. This D was the result day, and let's presume we put the options contract right here. Now on this day, this is 16th August and this is 7th September. So on 16th September, your option will expire. Now the point of telling you is, just look at this. The Bollinger Band keeps on contracting. So the changing trend of price going below the Bollinger Band and the trend changing now exists right here on the top. See? And your top point is really further apart. So if you need, you can adjust it further high. But I won't recommend that, because I would suggest you to have a gap in between. When I say you can adjust it further high, you can simply square it up by buying another put option and then writing another put option a bit higher. So the days that have passed will reduce the premium amount on this written premium, and once you will square it up by buying another put option. So if let's presume previously you were paid $1.30 for writing this put option, the next time you would be paying $1. So previously you paid $1.36, now you are paying $1. So that will give you a boost of 36 cents more. So if on the net credit basis you earned previously 10 cents, then by pushing the price up few cents, you can earn 10-20 cents more, which will increase your premium numbers. But I won't recommend that, because why earn a few cents when you can keep the full stock, right? Because the purpose of hedging is to try to hold on to the stock as long as you can. Please remember this. The real purpose of hedging is to try to hold the stock as much as you can. And if it goes down, then it's down. So you need to remember this. If it is going straight, you have to keep it. Because basically what really happens in hedging is, if you keep it, then you can apply another put and call option and earn another premium profit. And if the stock goes up or down, then automatically your stock gets sold. So basically this, like the thing that I discussed, you can like increase it to a further nearer level, will give you few cents in more in profit, 10 cents more in profit. But it will also like increase the numbers, because if you, let's presume, put it right here, the risk will be increased, because if it falls, your point of no return is really near. If it hits this, the other party can just claim your stock and like buy it, because in a put you're writing it down that you will sell the stock to the other guy as and when he claims it. Now he won't be claiming it when the price is higher. Sorry, this is the put option, so you can claim it as and when you like, right? And he needs to buy it no matter what. So if it goes down, then you should not be like really willing to take the risk, but you can increase it on top. So it will be like good, helpful by getting 10-20 cents more in profit through the premiums, but it will increase the price really nearer and will like really confuse you, because if you look at it further, 16th, 17th, the price suddenly dipped. Now, if you would have claimed or like increased the put option from this number to this number by squaring it right here, you wrote the put option right here, you can just buy another put option and it will square them out. So this will be gone, and you can then put another put option, that is, you can write another put option right here. Now, as many days have passed, so the premium will certainly decrease. So previously, if it was like priced at $1.36, then after 15 days it would be priced at let's say 70 cents. So you get to keep a 70-cent profit more. After deduction and everything, your 10-cent premium, that was net credit premium, would increase from 10 cents to 40 cents. That is good. But it increases the like distance. Example right here. It was trading at 57.43, but the next day suddenly dropped to 56.79. That's huge. Approximately $1.50. That's approximately 4%. So it opened 4% lower and went down. What happens next? It came back up from your point of no return, right here, the previous point. But if it would have gone down, you would suddenly jump in and buy your stock right here. Now, according to my plan, once it closes lower, it's a good point to get out. So if you would have increased it, it was a good point to get out. Number one. Number two. Let's presume you didn't like really made the difference. The put option was priced right here. So it jumped down, then came back up. Now what happens next? This was 15th day, 16th, 17th, 18th, 19th. We bought it here at August 16th. So September 16th would be the end day. And this is 14, 15, and boom, 16. Now right here you would have the stock with you, and the options contract expires worthless. So you get to keep the premium cents. And you can again apply the same options. Again, the same numbers. Why? Because still this red line, the put option that we initially placed, is below the Bollinger Band. And again, the same green line, that is the call option that we initially put, is above the Bollinger Band. So they both are like good numbers, still good numbers. You can again place the same hedging technique and earn again. And as the stock is moving within a certain band, your risk is further reduced. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. Now I am removing this line because we have put it below the Bollinger Band. 10, 11, 12, 13, 14, 15, 16, 17, 18. So it was 16th September, right? Right here. So 16th October it will again expire. and this is 13th, 14th, and this is 16th. This is 17th, Monday. So if you look at it, again it expires worthless. So again you earned it, and you already own the stock. Now, as we discussed earlier, hedging means you want to hold the stock, but you don't want to hold the stock going down. You want to hold the stock if it goes straight, because on the long run, you believe Microsoft is a good company, so its stock will rise from 60 to, let's say, 70. So you are putting in the hedging technique, and you're thinking, okay, if it breaks 56 right here on a red line, I will be out. And if it goes to 60, I will be out. But if it goes within the middle band of 60 and 56, that is this $4, then I get to earn the premium amount, that is 10 cents. And on each expiry, I will again claim it. Right here. Now we have put in the third month options contract. So it's 1 day, 2 day, 3 day, 4th, 5th. Now on the 5th day, automatically your stock will be claimed and you will be out. So you get to keep the stock for 2 months, and then it suddenly jumped up. This is the game. And once you get your stock gets squared, so if you need, you can buy it again, or according to your initial prediction, $60 is a good profitable position, so you just went out. Boom. No problem at all. And within a few days it again came back down. So the point of view is, this is the game. This is hedging. Now, as we discussed, the takeaway points is, once the Bollinger Band contracted, you could have increased the put option a bit on top. Once your top and lower Bollinger Band expired, you could increase your top call point up, call option up. But it doesn't really affect it because it's further really high. So if you would be putting it more high, it won't be making much sense. But on the call option, if you increase it nearer, we saw that it suddenly opened lower, and your put option will be claimed. You need to claim it because the stock is going down. So you'll be sold out right here on this day. But the stock came back up. So your initial point, which we did it right here on this result day, the put and call option, was placed correctly. How? Because it was placed on the previous support line. See? This open, this open, this open, this open. These are the 4 opens around $60. Yes, you might say they're a bit near or a bit lower, $59.90. But once you are buying once you're writing a put option, usually it's a round number. So you had to select $60 or $59.50. Now what is $55.50? It's this point. So you can either select $55.50 or 60, as we did 60. So the point is, this is the hedging technique. You apply it. You want to save the stock if it doesn't go down. But if it goes down, you want to simply sell and get out. The top number should be a bit high enough price. That is a good profit. Example, right here when we traded it, the price was at $57.50. So our top number was at $60, which meant approximately 5% up. So we knew that if it goes up, then 5% is a very good profit. If it goes down, then it just dollar difference, it would have just crashed below this point. Then it would have crashed down to the number where we bought it again, 50.51, right here. If it would have crashed down. So both the numbers, the strike price, should be selected really carefully. Because if you don't select it carefully, you have to sell it one point or another. Example right here. We put another strike price here and increase our premium profit, but the next day it opened lower and we have to claim it because we don't know it will come back up or not. It's a future for us on this day. So on this day we would be squaring it and booking profits because we don't know what the future is. So please do remember this. Your call option can be higher. It really doesn't gives you problems. This is a high number and profitable number, so it's not a problem. But your put option strike price is really important. So select it usually on the support level, but below the Bollinger Band or on the Bollinger Band. Right here on this day, once we traded it, we knew the Bollinger Band was lower and our strike price was at 60 and Bollinger Band was at 55.50. But as we know, as we traded here, it was contracting. We traded on this day because Bollinger Band contracted. Right here it's 53.61, 59.35, and then 59.32, and then 59.28, and then 58.73. So it's 4 days and it's going lower, lower, lower. It's contracting from the top, from the bottom. So we knew our number, our strike price on the put option will automatically come below the Bollinger Band because the Bollinger Band will contract, and that's what happened. We traded on this day, on the result day. The next day it contracted, the next day it contracted and reached our point. And again it contracted, and it was really a small band right here on this day. So contraction is the number one thing where we place the hedging technique. Thank you.